It seems like most of the people I encounter don't really understand how our progressive tax system works. When they see they're in a certain tax bracket, they think they pay that percentage on their entire income. That is not how our system works. For example, if you get a raise that barely puts you into the next tax bracket, you are not going to end up taking home less money because of being in a new tax bracket. That's obviously ridiculous and unfair, and thankfully that is not how our tax system is structured. First, let's look at a table that you've probably seen pretty often. I truly hate the way this table is structured because it's not really obvious that you're taxed in each tier. It looks like if I was single and made $100,000, I'd be paying a 24% tax rate on it, right? Because I find where $100,000 would fall and it's in that 24% row, so that's got to be it, right? No. Instead, you should be looking at this other table that's on this other web page, which more accurately portrays how it actually works. Here, it's got a quick explanation of what you owe based on your total income. So if I made $100,000 this year, I'd find my range, which is right here. And you see it says that I should take home $14,089.50 plus 24% of the amount over $82,500. That means we're only being taxed the higher amount for that specific range of income, not the entire $100,000. So this table makes it easier for you to calculate what your actual tax rate will be, since it gives you the amount to start with in your range. So in this case, let's just do the quick calculations. So if I bring up my calculator here, $100,000 minus the income I've already paid taxes on, which in this case is $82,500 because we've already been taxed up to that rate, minus $82,500. So that's $17,500. And that's the amount of our income that gets taxed at 24%. So 24% of that comes out to 42%. So if I do that 24, there's 4,200. Now if we add that to the figure given to us on this table of 14,089.50, that gives us a total, shows that we owe taxes of $18,289.50. on an income of $100,000. So you'll notice $18,289.50 is not 24% of your total income. 24% of $100,000 would be $24,000. So why is that? Now the key statement is shown on this page, and it states, remember that moving into a higher tax bracket does not mean all of your income will be taxed at a higher rate. Instead, only the money that you earn within a particular bracket is subject to that particular tax rate. So I'm going to go through a few examples because that's the way I learn best, and I'd assume some of you are the same way. So first, let's pretend like it was just that simple, where if I made a certain amount, I'd find the row of my tax bracket and take off all that money. I'll show you an example of why that's unfair and why it's not done. All right, so let me bring up my Excel sheet here just to show how it would look, how the wrong way to calculate taxes if we just took a straight percentage based on what we found in that tax bracket. Let me bring these up just so you can see them behind here. So if, let's say you made $38,000 this year, and remember all these rates that I have going for me here are for the 2018 tax bracket. So if you're watching this later, 2019, 2020, these ranges will be different because it goes up every year for inflation pretty much. But let's say you made $38,000 in 2018, and if you find $38,000 in this range, you can see it falls within the 12% range right here. So if you just take straight 12% off of $38,000, that comes out to $4,560. You see this calculation here, 38,000 times 0.12, that's 12%, $4,560. Now let's say you got a $2,000 raise, or somebody makes just $2,000 more than you. Now they're in the $40,000, which is this 22% range. You can see the range here goes from 38,701 to 8,250. So now they're in that 22% tax bracket. Well, if they took 22% of the entire 40,000, that comes out to a whopping $8,800. That's way more than the $4,560 that you paid making $2,000 less. And you can see the total take-home pay from that would be $31,200 versus $33,440 for somebody making $38,000. So that's obviously unfair. Somebody making more money would get taxed so much more highly that they would actually take home less money. That is not how it works. No, not how it works. So what's the correct way to calculate these two examples for 38 and 40? All right, so let's pull this up. So the correct way to calculate this is by the ranges. So the first 95.25 that you make is taxed at 10%. So the income that's taxed so far is 95.25 at 10%. That comes out to $952. Now you go into the second range, which is the range you'll end up in. This is your last range that you have to calculate tax in this example. So the money you make within this range is taxed at 12%. So only the money you make within this range is taxed at 12%. Your first 95.25 was already taxed at 10% at a lower rate. So the way to calculate that is we have $38,000 and we're going to subtract what we've already gotten taxed on. So $38,000, that's what this B9 points to, is at $38,000. And we subtract 95.25 and we get this figure of $28,475. So on an income of $38,000, the only portion you pay 12% tax on is this $28,475. And that comes out to $34.17. So 12% of $28,475 comes out to $34.17. You add up the two ranges of taxes that you owe, that comes out to $43.69.50. And if we take a look at what the originals were, you can see the take home in this case with this progressive tax system, it's $33,630, which is a little bit more than $33,440. And that's because you paid a lower tax rate on the first 95.25. Okay, so that's the first example, and now this next example is the one where you can really see the difference between just calculating a straight 12% versus 22%. So if we go down here and check this one out, you can see you do exactly the same thing within this 0 to 95.25 range. You take 10% of that, you owe $952.50 on your first 95.25, exactly the same as the first person. And then the second range is slightly different because you're going to be making more than this top part of the range here, this 38,700, you're making 40. So we're going to take 38,700 and subtract the 95.25 we've already paid taxes on, and that comes out to $29,175. So that amount is going to get taxed at 12%, which comes out to $35,001. And then in this next row here, this is where your $40,000 person will fall. It's right in the middle. It's right in the very beginning of this range here. So what we want to do is figure out how much do we have left that gets taxed at 22%. We've already been taxed on the first $38,700. We've already taken 10% and 12% out of those particular ranges. So if you take $40,000 and subtract what you've already gotten taxed on, $38,700, there's only $1,300 left of that. So only this $1,300 is getting taxed at 22%. And if you do the calculations on that, that only comes out to $286. So out of this $1,300, you're taking 22%, not out of $40,000. So you add up all the tax that you owe in each range, and it comes out to $4,739.50, making your take-home pay on a $40,000 year $35,260, which you'll note is higher than it was if you made $38,000. So this is really the main point I wanted to add. So if your salary goes up from, I wanted to prove, if your salary goes up from $38K to $40K, you still take home $1,630 more dollars at $40K than if you didn't receive that raise. That's the core concept here. You get taxed in each bracket. You don't tax your entire income based on the highest tax bracket you meet. Think of it like this. The first paycheck of the year would take 10% out of your check because you haven't made $95.25 yet. You'll continue to have 10% taken out of your check until you reach $95.25. Once your yearly income goes above that, your paycheck will start having 12% taken out because you've hit the next range. So it'll be a little less take home if you're on a salary and have the same pay each paycheck. And that will continue until your yearly income passes $38,700, and then your paycheck will start having 22% taken out of it. Now, this is not how your employer will actually withhold tax for you, but in effect, this is how it works. The more you make, the more percentage will be taken out from there on. It won't retroactively take more money out from your previous paychecks. That's kind of how I think of this system. Those have already been taxed, those previous paychecks, so you're being taxed more on the extra money you're continuing to make. Okay, but hold up, there is a standard deduction that you have to take into account. For a single filer, it's $12,000, and for married, it's $24,000. And that means, in the examples above, you'd actually only be getting taxed for $26,000 and $28,000. So if we go and calculate those instead, I'll just kind of quickly go through these. You do the same calculations. You do your first range of $95.25. You still owe $952 on that first bit. But in the second part here, you're only going to go up to a total of 26,000 for somebody who made 38,000 because you took 12,000 off of their taxable income. So that makes the amount that you're going to get taxed go down by $12,000 here. So instead of up here, you could see we had a income tax of $28,475. The one down here now is $16,475. And so we just take 12% of that lower number, and that makes us take out only $1,977 with a total tax of $2,929.50 for somebody making $38,000 and taking the standard deduction. So with that standard deduction, you save $1,440 in total based on taking those $12,000 off, making those not taxable. And the same thing applies here, and you'll actually note that in this $40,000 range here, you actually don't even go into that third tier of 22% because we've took $12,000 off of 40, which means you actually are only getting taxed on $28,000. So it works exactly the same way here. It's just $2,000 more getting taxed, and the total tax coming out is $3,169.50. And based on the previous one, you actually are going to save $1,570 based on that standard deduction. So one other thing I'd like to point out here is just the actual percentage that you're paying. So up here, before the standard deduction, the percentage that you were actually paying in tax rate up here was saying you were paying $43,695.50 for a take-home of $38,000. That would actually work out to 11.5% federal income tax. And down here it was slightly more because you made slightly more money and went into a higher tax bracket. So the actual rate on $40,000 you were paying this much on, that works out to 11.85%. So even though you were in the 22% tax bracket, you were in effect only paying 11.85% of your total money made because of this tiered system. And down here you can see it's way less because it's $12,000 less than those examples. It's 7.71% here and 7.92% here. $29,2950 is only 7.71% of $38,000. And the same thing here, $3,169.50 is only 7.92% of $40,000. So if you make $40,000 and you're a single person filing single and take the standard deduction, you are only going to pay 7.92% federal income tax. All right. One more example within this Excel sheet. Let's say you're married and you and your spouse combined make $120,000 in a year. So let's say we each made $60,000. That would be a total of $120,000. And let's just see how that works out with this system. So if we made $120,000, we would immediately take the standard deduction for the year, which is $24,000, twice the amount that it is for single. So you take $24,000 off if you're filing married jointly, and that comes out to $96,000. So if you make $120,000 between you and your spouse, immediately your first $24,000 that you make is free, doesn't get taxed, so you're only going to be looking at $96,000 here. Okay, so the way it works here, it's a little bit different when you're doing the married filing jointly because the ranges are a little different. It's taking into account two people instead of one. So you can see here it goes 0 to 19,050 instead of 0 to 9,525 like it does for single. But the rates are the same on the ranges. It's just the different amounts on each of those ranges. So 0 to 19,050. So the first $19,050 that you and your spouse make are taxed at 10%, and that means 10% of that comes out to $19,005. So same concept as before with the single ranges. It's just a little bit more. You can make more at the lower range. So the 10% of your first $19,050 comes out to $19,005, and then we move into the next range of the 12% tax rate. And same concept applies here. It's just different ranges. So the amount that you're going to get taxed here between $19,051 and $77,400, we're going to take $77,400 and we're going to subtract the amount we've already been taxed, which we've already been taxed on our first $19,050. So if I subtract $19,050 from $77,400, we get this figure of $58,350. So that amount of your income is now being taxed at 12%. 12% of $58,350 comes out to $7,002. So that's done with your first $77,400 bits of income. So now if your total income that's taxable is $96,000, we need to take $96,000 and subtract $77,400 from that because we've already been taxed on our first $77,400 and we fall into this 22% range. So what's left over after that is 18,600. So 18,600 plus 77,400 will give you this 96,000 figure. So that's what we're going to get. That's what's going to get taxed at 22%. So that's all that's left for our income within this range. And that means 22% of $18,600 is $4,092. So if you add up all the taxes that you owe within each of these income tax ranges, that comes out to almost $13,000 exactly, $12,999. So $12,999 is what you owe if you make $120,000 jointly between you and your spouse. And that actually only comes out to 10.83% of $120,000. So you can see, even though you would fall into that 22% range, you're still only paying effectively 10.83% of your total income. Now, if we compare this to the original wrong ways to calculate this, if you just took 22% of $120,000, that'd be $26,400, way more than $13,000. And if you took 22% just from the $96,000, so if you took the standard deduction into account, you would owe $21,120. So again, this is significantly different than if you just took the full 22% amount from this based on these, compared to these tiered versions. So again, the right amount that you would actually get taxed on $120,000 joint income between you and your spouse will only get taxed at $12,999. So it's much less with the current progressive tax system that we have. So that's what I wanted to show. If you get a raise that gets you into a higher tax bracket, you will still make more money. The extra percent of tax will only kick in on those higher ranges of income. So if Congress passes a law to raise the highest marginal tax rates, your taxes will not go up at all unless you make over $500,000 as a single filer or $600,000 as a married filing jointly. You can see that the very top tax bracket is 37% for anything made over $500,000 for a single person and $600,000 for married filing jointly. So if you made $1 million as a single person, only $500,000 will be taxed at 37%. The first $500,000 is taxed according to these lower ranges that everyone else goes through. So maybe as the last fun example, let's just see what our tax rate would be if we made $1 million and we're filing as single. So first, let's just take the $12,000 standard deduction. Although it's important to note here that if you're making this much money, you may be able to itemize deductions that might come out to more than $12,000. But just for the sake of simplicity, let's just keep this simple and we'll continue through. So let's just take $12,000 off of $1 million. That's going to be $988,000. So just to show, 1 million minus 12,000 gives you $988,000. And then we need to figure out how much of our tax after the fact is going to happen. Let me actually bring up this other more useful table. So you can see if 500,001 or more, you have to pay $150,689.50 plus 37% of the amount over 500,000. So what is the amount over 500,000 if we've made $1 million and we've taken 12,000 standard deduction out? So that's 988,000 minus 500,000 that we've already been taxed on. So $488,000 is what gets taxed at 37% because all our previous income has already been taxed at the previous ranges. So 488,000 times 0.37 will give us 37%. That's $180,560. And if we add that to what we've already paid, $150,689.50 right here, and calculate that, that means if we made $1 million, we would pay the federal government $331,249.50. If you do a quick calculation on that, that means that you're paying 33.12% of your total tax. So even though your top rate for a millionaire is 37%, you're still not paying 37%. You're paying about 33.1% because of the tiered system. Now, the higher you go, like if you're a billionaire, if you make $500 million in 1 year, you're going to get pretty close to this 37% mark because of how much money you make in this higher tier. But yeah, I mean, that's just what I wanted to show. And the main core concept I wanted to make clear is that if you make more money, you will not be taking home less money, even if you're right on that range of a higher tax bracket. Always take your raise. You will make more money. You will not get taxed more to where you'll take home less. All right.